Alright guys, welcome back for another video. This will be a little bit of a psychological video. The topic is the topic of Black Swan events. I think it's really important to define what a Black Swan event is first, before I jump into it. And really a Black Swan event really represents a extreme market condition that is outside the expectations of participants within the market. And it's inherently something that can't be priced in, right? Because the market is not even considering it to be a possibility. Now, with Black Swan events, those are things that are unique to the present moment, right? So if you go forward in time after a Black Swan event plays out, there will be people in the market who claim to have predicted it, right? And said they knew it all along. I mean, that's just typical behavior of people, analyzing the market. A good example, though, is like the COVID 2020 Black Swan event, right? The governments around the world, shut down businesses, mandated businesses got shut down globally and disrupted global supply chains. So, of course there are guys out there who are going to say, oh, I knew that was happening. But the reality is nobody knew that was even a possibility because it had never happened before. Governments had never done that before. So I don't really believe anybody who claims to have known that was coming, right? I mean, they may have been luckily in a short position when it happened, but that doesn't mean that they knew what was coming, right? That's a different thing. So that type of thing is something that you can't price into the market. You can't, your TA is not going to matter. You may have a bullish setup when something like that happens. And, of course, your TA is not going to matter in those moments. Black Swan events represent existential risk. And they're risks that you can't, it's not like the price chart is going to tell you when it's going to happen. Right? The Black Swan events can happen at any moment. That's another important thing to consider when you're thinking about a Black Swan event, is that it's not like that you'll see it coming or know it's coming, or that the price chart will demonstrate that in any way. It's quite literally something that is unpredictable, inherently unpredictable, is totally going to catch the market off guard. And the entire market thinks it's not, it exists outside the possibilities of market participants, right? Now, if you don't think that there are expectations and, that type of expectation placed on the market, I would argue that that's pretty obvious that there is, right? I mean, there are certain things that people believe to be possible, and then there's, possibilities that exist beyond that. A good example would be, obviously March 2020 and what we saw happening there. But it's important to keep in mind that not all Black Swan events are downside risk, right? You could have a Black Swan event that, causes price to rise dramatically to the upside in a way that people don't think is really possible. A good example would be, during the March 2020 Black Swan event, price declined by significantly over 50% within a period of a day. So, roughly 60%. The equivalent of that to the upside would be price increasing more than double, significantly more than double within one 24-hour period. So imagine if, Bitcoin traded to 50,000 from its current price at 20,000 in a daily candle, right? That's like the type of thing where people don't believe that that's possible, and I agree with them that it's extremely unlikely. But it is even a low possibility. It's a real possibility, and things like that do happen in the market. Markets do go limit up or limit down, conversely. Not in crypto, right? There's no limits in crypto, but a good example of that is there's the Hunt silver debacle, where a bunch of wealthy individuals tried to corner the silver market, and it caused the silver market to go limit up for a period of several days and weeks. So that's a good example of a black swan event that happened to the upside. So it's not always downside risk. And these type of risks in the market are risks that are the most difficult to manage because you can't manage them with a stop loss, right? If during a lot of these black swan events, a lot of times you may have a stop loss in the market, and your stop loss won't trigger, right? Price will just gap above or below your stop loss. And if you have a significant position size on, that could be a career-ending mistake. So it's a different type of risk. It's an existential risk, and it's the type of risk that generally ends people's careers, right? People generally don't, some people go down like losing spirals and blow their account that way, but most people, I would say, actually end up blowing their account through exposure to a black swan event. And the insidious nature of it is that if you're exposed, if you're successful, you're going to have more time in the market. And if you're somebody who believes in hard work and really grinding out those numbers, you're going to just exponentially increase your time in the market, which also increases the likelihood that you'll be active with risk in the market when a black swan event occurs. So throughout the course of a trading career, we have to endure these black swan events if we want to survive and continue on in our career as a trader. And so the purpose of this video is to talk about how to manage that risk. And I think, this is kind of really the only way to deal with this. Well, first is to understand the unique risks and existential risk of whatever asset you're trading. But it's also an argument for diversification, right? Because if you're trading different assets and you have your net worth kind of distributed across different asset classes and different trading accounts and different market environments, well, you're sort of you're quarantining that risk to one area, right? So if you get blown out, if there's a black swan event in Bitcoin and you get blown out on Bitcoin, that's something, and that's compartmentalized to like a fraction of your net worth, then that's something you can recover from, as opposed to like 100% in Bitcoin. Now, I don't think that, hear me out when I say this about Bitcoin, I don't think that you have to worry about that by just holding Bitcoin. But if you do have a leveraged position in Bitcoin, right, you don't want that. You don't want a leveraged position in Bitcoin to represent, the entirety of your net worth, right? Because if you have that leveraged position on, and you get caught up in a black swan event and the trade goes against you, that's it. That's over. A good example of this that is a realistic scenario in the crypto market is the Ethereum move to proof of stake. So you guys may have heard some of my videos about Ethereum and talking about how bullish I am about the recent transition to Ethereum's proof of stake and the kind of deflationary effect it will have on Ethereum's supply schedule. So I would describe myself as, short-term neutral on Ethereum price action, medium-term bullish, and long-term bearish. And I'll explain that. I'll break that down because, essentially, short-term volatility is almost inherently random. It's very difficult to attach any meaning to it. But again, now that we move on to the medium term, Ethereum's supply schedule has increased dramatically. So I'm saying like months to years, say several months to several years. You have that deflationary effect. It's like a Ethereum halving, so to speak. And that will have a measured effect on the price of Ethereum because ultimately it's supply and demand. Supply goes down parabolically and demand remains constant. Then the price of the asset's going to go up. Now, the reason why I can be medium bullish on Ethereum in the medium term and bearish long term is because the switch to proof of stake for the Ethereum network introduces significantly more centralized points of failure in the network. And the reason for that is because now, entities with the largest stake in the network can manipulate the network and exploit the network and start to censor transactions. And that's the type of thing that doesn't play out immediately. It sort of, because the Ethereum stakers have an incentive to maintain the network, right? If they come out and they destroy the network immediately, then they lose their entire stake. They lose all their Ethereum. So they do have some degree of incentive to maintain the network and stabilize the network, but they also have an incentive to exploit the network. And they'll do that in incremental steps, in minuscule steps that don't really add up to anything at first, but it's the type of contagion effect that as you stretch the time horizon out, that sort of thing adds up, and you can get into it's just not a sustainable model over the long term, right? Ethereum will at some point reach an existential crisis due to the central points of failure introduced in the system. And so in that way, I see the real risk of Ethereum as the network failing, right? And that would be a Black Swan event. And that, again, tying it into the topic of this video, if there was a network failure in Ethereum, that is a truly Black Swan event. Of course, the stop loss is not going to save you from that. Whatever Ethereum you have is not going to be worth anything. And it's even a situation where, if you have Ethereum, a major short position opened on Ethereum, then, and it's collateralized with Ethereum tokens, so collateralized in the native token, and you have that massive short position on, and the network goes to zero, you'll have theoretically an infinite number of Ethereum tokens because the value will have gone to zero. So you'll have an infinite number of Ethereum tokens with that short position, but it won't be worth anything. You won't be able to sell them because the network failed. So it's a good example of like a Black Swan event, how like even if you were directionally right, you still lose your entire position. You still lose whatever stake you had in the network. So that's a different type of risk. And that's why I suggest that anybody who's getting involved in Ethereum, you can protect yourself by hedging yourself in the cash settles futures market, right? So if you have a short position, hedge in the cash settled futures market, and that type of Black Swan event plays out, well, because it's the cash settled futures market, you can reclaim that hedge and mitigate your losses, where you wouldn't be able to do that in a coin margined futures market. Anyway, just an example of like a realistic possibility of a Black Swan event. Now, again, it may not be the best example because it's something we can predict, right? But it's still a real risk. I think, though, the nature of Black Swan events is that they're inherently unpredictable. So a lot of the risks that we're not even thinking about are very hard to even plan for or consider. And the only way to do that is compartmentalize risk, diversify your trading accounts, your exposure, and to be open to the possibility of it happening, and open to the possibility that something that you have no idea that could happen will happen given enough time. And these are critical moments to survive in a trading career. And again, it's also a reason to actively hedge your positions in the cash settled futures market, because doing that will the people who have those hedges on during the Black Swan event they're going to be the people who survive and don't blow up. Again, so the title of this video is, you know, about black swans, but it can also be an argument for hedging. And you know, when you think about what a hedge is, when you put a hedge on, you're opening yourself up to the possibility that your trading idea is wrong, right? Because if you didn't think that, you wouldn't put the hedge on. And just the act of putting the hedge on opens yourself up to the possibility that you're wrong, and it puts you in line mentally with the realities that exist in the market, right? That anything can happen, and you don't know what the outcome will be. So you might as well open that hedge and protect yourself, so that if the worst case scenario plays out, that you'll be able to live to fight another day and, you know, continue your trading career. Anyway, I hope you guys liked this video. If you haven't subscribed to the channel, be sure to subscribe to the channel and look out for more trading journal videos, psychology videos, also macroeconomic videos. Catch you guys in the next one.